Hey guys, Dave Keller here with Market Misbehavior. Today I'm going to break down for you one chart with 5 measures of market conditions. So there's so many different ways we can measure the strength or weakness of the financial markets. Lots of different measures of the equity space, other asset classes, and then measures of breadth, sentiment, trend, momentum. There's so many different inputs we could consider in any given moment. What I like to do is create one chart that combines a bunch of different sort of data points all in one place, with the goal that I can look at that one chart and just get a sense of the overall conditions. This particular chart I'm going to show you is one that I set up years ago as a way to just measure some of the general trends in market conditions, things that I could at a glance decide whether or not the conditions are bullish or bearish, and start to dig into the reasonings behind that in terms of leadership and relative performance and things like that. Before I show you the chart and the 5 different components, just as a reminder, if you like this sort of thinking about technical analysis, market history, and investor psychology, won't you subscribe to my channel? Also give the video a like if you appreciate it. We'd very much appreciate that back. Put a comment below. Which of these indicators do you think is most meaningful here and why? Let me know. Looking at the chart here, you'll see we have the S&P 500 and 4 other items. So here's the S&P 500 on a closing basis at the top of the chart. Next, we have the relative performance of consumer discretionary versus consumer staples. Now we have the relative performance of semiconductors. We have small caps over large caps, so the Russell 2000 over the S&P 500, and then the equal weighted S&P versus the S&P 500. Let's go through each one of these in a little more detail, and you'll see why they each earn a spot on the market conditions chart that I'm showing you. Now, first off, it's just the closing price of the S&P 500. Now, before you think of that as just sort of the trend in the markets, you have to remember that market trends have information in themselves, right? Embedded in themselves. It's one of the great, I think, benefits or central tenets of technical analysis is that price has information, or price is information. Price has value. And by analyzing the trends in price, by analyzing inflection points and movements over time, you can get a sense of what's happening underneath the hood in the market. A lot of people just look at the fundamental data, macroeconomic data, geopolitical data, and then just see how the trends are moving as a result of all of those things. As technical analysts, what we believe is that the markets themselves actually have information because it tells you about the interplay between buyers and sellers. Or maybe to put it a little better, the interplay between buying power or the demand, the need to own more of something, versus the selling pressure or the natural pressure, the natural rotation away from a certain asset. And prices go higher when buying power overwhelms selling pressure, and prices go down when the opposite occurs. So the fact that the S&P is at the upper end of the range for the last 6 months is pretty bullish, right? The fact that the S&P is above 4,100 here currently in mid-April is pretty encouraging. The further that trend continues, the more bullish that is. One of my mentors, Paul Montgomery, who authored a newsletter called Universal Economics for over 50 years, he used to say the most bullish thing the market can do is go up. That's certainly what I think we've seen. Now, arguably, the trend is more sideways for the last 10 to 11 months. I think that's probably fair because we're currently at the same level we were kind of in late April of last year. However, if you look at the last 3 to 6 months, hard to argue the fact that we've really come off the October lows and at the upper end of that range. That's pretty impressive. So the first component of the 5 is actually pretty constructive. The rest of them a little less so, from a little bit bearish to a lot bearish, and I'll show you one by one. The second panel down is the consumer discretionary versus consumer staples, and we're using equal weighted ETFs. The RCD, which is kind of an equal weighted version of the XLY, which is a commonly used consumer discretionary ETF. Instead of the XLP, we're using the RHS, which is an equal weighted consumer staples ETF. Let's talk about this in particular. Why are we looking at consumer discretionary versus consumer staples? This is a classic measure of offense over defense, and it's based on whether investors are rotating to things you want or things you need. When conditions are good, when the economy is strong, when consumers have a lot of money to spend, they tend to buy discretionary goods, right? They tend to buy things that you wouldn't normally buy if things are tougher. Things like discretionary purchases, like a new house, a new car, travel, tourism, all those sorts of luxury goods like watches and jewelry and such. And so consumer discretionary really represents those things you don't really need, but they're probably things that you want. If you have the money available and you don't have a lot of worries in your life, maybe you take a shot at something like that. Consumer staples are more the things you need, regardless of what the conditions are and regardless of what your financial well-being is. You still need a place to live. You need shelter. You need clothes. You need household goods, toilet paper, beverages, alcohol, tobacco, all kind of fit into those consumer staples, right? They're sort of recession proof, meaning even when things are tough, you're still going to need toilet paper, right? So the fact that we can look at that ratio just tells us what's doing better. The things you want, consumer discretionary, the things you need, consumer staples. It's a great way of measuring sort of offensive versus defensive pressures. Now we're using the equal weighted ETFs because something like the XLY is dominated by just a couple stocks. So Tesla and Amazon alone make up almost half of the XLY, and as a result, it's way too top heavy if you're trying to analyze the trends over time. But by looking at an equal weighted ETFs on both sides, we can do more of a general trend in those types of companies. Now, if you look at what's happened in this ratio over the last 8 to 10 weeks, it's been going down. It actually made a new high going into the February peak. But from there, from February, the beginning of February to where we're at now in mid-April, it's actually been trending lower. And that's not a great sign for the risk appetite of stocks, because that indicates that investors are getting more defensive than offensive within the consumer space. Now, another sort of group to look at is semiconductors. I like following the semiconductor group because it's sort of a bellwether group. Pretty much everything we do in 2023 is driven by semiconductors, right? I mean, computers, cell phones, any sort of other device that you might own, a lot of things in your kitchen, a lot of random other things, all have some sort of chip in them. And as a result, the performance of semiconductor stocks really tells you about the strength of the economy. When we need more semiconductors for more things, that's usually a good sign for economic conditions, and the opposite if they're going down. Now, semiconductors have been one of the better groups off of the October low. The relative performance of semiconductors has actually been going up. We're using the SMH, which is the VanEck semiconductor ETF, but there are others like the SOXX with a similar sort of liquidity, similar sort of structure. And both of those have done very, very well off the October lows. Semiconductors, along with like gold and a small number of other groups, have been really the top performing plays off of that October low. If you look at what's happened in the last couple of weeks, though, that's actually rotated lower. So the S&P is once again sort of rotating higher, testing, breaking above 4,100. Semiconductors have actually been going down over the last couple of weeks. Still early on to declare this a broken trend, and I don't know if I could necessarily say that because they're still kind of making higher highs and higher lows. But I am very much looking at that recent pullback to see if it continues, because if semiconductors would go down, that would be a very different vibe to this market than we've seen from October to April. The fourth one down is the relative performance of small caps. And we're using a small cap ETF, the IWM, which tracks the Russell 2000 index. You can see that small caps actually were holding in there okay going into the February high, but then rotated lower. And in the last 8 weeks or so have actually been in almost a free fall. Now, why is this happening? If you think about it, think about the stocks that have been leading, the stocks that have been doing well in March and into early April. It's the FANG stocks, right? The mega cap stocks. Look at the relative performance of the S&P 100, which is an index of the largest of the large caps, versus something like small caps. It's clearly been favoring the OEX or the S&P 100. It's clearly been favoring those mega cap names because the Apples, Microsofts, Netflixes, Nvidias, Amazons overall have been doing much, much better than the average stock in the market. Starting to change a little bit. Certainly recently we've seen a bit of a pullback in some of the FANG stocks, but overall a lot of them still holding up very, very well. What happens in general is when market conditions are strong, when the economy is good, and when investors are optimistic, they tend to take on additional risk. That's really the general thesis to equity investing, right? If you want no risk in your portfolio, you buy treasury bonds and you sit back and they're basically risk-free and you collect a yield, and that's about it. But if you want to have the potential returns that equities can provide with 5, 10, 15, 20+% returns in a year, you also have to take on additional risk. And that is called the equity risk premium, right? You're taking on additional risk for the opportunity for greater return. So here's the thing: when investors are taking on additional risk, they don't tend to, diversify into big blue chip names like Walmart or Pepsi. You tend to go into the smaller, higher beta. And what that means is basically higher volatility, higher risk types of names. You tend to be smaller, less known, less proven companies that have more potential for explosive growth going forwards. So when small caps are underperforming, it doesn't necessarily mean that the market is broken, because as we've seen in the last month or so, the market can go up if small caps are lagging. However, I've learned over my career to feel much better if small caps are doing well, because that represents that institutional investors are taking on additional risk. The relative strength of small caps is actually telling you the opposite right now. It tells you that investors are getting a little more cautious. Last one on the bottom is the equal weighted S&P versus the cap weighted S&P. And this goes back to what we were talking about with the equal weighted ETFs when we were talking about the consumer discretionary versus consumer staples. When we're looking at the S&P 500, it is dominated by some of the largest names. As a matter of fact, the top 10 names, the largest stocks in the S&P 500, things like Apple and Amazon and Microsoft, if you look at the weight of those top 10 stocks, it's about the same as the bottom 350 stocks in the S&P. And just to make that clear, the performance of the top 10 largest stocks in the S&P have about the same weight in the index as the bottom 350 stocks. That is how big of an overweight those mega cap names are. And again, because they're so big, because the market cap is so big, they dwarf all the other smaller names in there, right? So as a result, by looking at the equal-weighted S&P versus the cap-weighted S&P, we can think more about the broader group of stocks, right? Not just what the largest names are doing, but what about the other names, right? Those other 350 stocks, how are they doing? By looking at equal-weighted versus cap-weighted, we are basically looking at the performance of the smaller names in the S&P, which are still larger, kind of mid-cap, large-cap names, versus the mega caps. The same as we talked about with the small cap performance. The fact that this has been trending downwards, essentially year to date, that bottom panel has been going lower. That tells you again that the smaller names in the S&P are doing a lot worse than the larger names. Now again, can the market go higher with that configuration? Of course. And if you look back to 2021, for a lot of that year, the market was going higher, really driven by the mega caps. A lot of other stocks actually came along for the ride. But again, over my career, I've learned to be skeptical of rallies that don't have stronger breadth and don't have strong enough participation from some of the small and mid-cap names, because those represent higher risk, more a greater risk appetite, which usually implies that investors are more optimistic. When the market's going higher, driven just by the mega caps, that tells me to be a little more concerned, because that's really where investors would rotate if they want to get defensive. You'd go into big names like Walmart, things like Pepsi, but also things like Apple and Microsoft, which have become kind of the blue chip technology names of our day. So that is a chart, what I call 5 measures of market conditions, really looking at the closing price of the S&P, looking at offense versus defense in the consumer space, the relative performance of semiconductors, small caps versus large caps, and then an equal weighted S&P versus the large cap regular S&P 500. Again, the fact that the S&P is going up is probably the most bullish piece of evidence that I will show you. But all the other 4 items that I've shown you today are either not as good as they had been, like semiconductors, flat out negative, something like the relative performance of the small cap space. And overall, that tells me to be skeptical of further upside for the major equity averages. What do you think about this chart? Which of these indicators do you feel is the most meaningful to follow here, and why? Let me know in the comments below. For Market Misbehavior, I'm Dave Keller. Be well, stay safe. Talk to you again soon.